Welcome. Our next presenter will be Mr. James L. King, State Director, New York Small Business Development Center. Welcome, Mr. King.
Thank you, Madam Chair. Mr. Chair, members, thank you for the opportunity to come up and follow Pat, who specifically took about 70% of my presentation. So that's fine also.
So you're going to say ditto to all of that?
Yeah. You know, I felt like coming up and just saying I'm dramatically opposed to most of the online lenders, and I could get up and leave at that point. But let me just share a few comments. The SBDC, if you don't know about us, we're a network of 24 regional service centers across SUNY, CUNY, and 2 privates, Columbia and Pace. Our mission is education. We're building the small business acumen of the entrepreneurs and small businesses we deal with every year. And every year we deal with about 20,000 of them on a one-to-one basis. Another 15,000 in a training environment, because we offer about 735 training events on an annual basis. So we see a lot of the small businesses. Our businesses attract annually about $270 to $300 million in capital. So we help them access that capital they need. In terms of demographics, this year, for the first time, a majority of our clients are female. And historically, we've never gotten to that point. We went to 51% this year.
You know this is the year of the woman, right?
I didn't at the time, but I'm pretty sure of it right now.
Never admit that.
It's always the year of the woman.
You sound very much like my wife. But we do have, a long history of doing this. We've accessed or help our clients access over $5.7 billion since the start of the program. And that has encompassed 417,000 New York entrepreneurs and small business owners, about evenly divided between startups and existing businesses. So we have a fair amount of experience in that, and from my own perspective, in the past 34 years, the small business lending environment had been pretty consistent. And then about 2.5, 3 years ago, it changed dramatically with online lending. And what I'd like to do is just stray from a little bit of the comments here and give you the experience that I had with online lenders. And that was because we see a lot of small businesses. It's a tough market to gain access to, so a lot of people want us to give them referrals. And we try and look at exactly what those referrals might mean to a business, improved access, greater technology, whatever else might be necessary. But our one policy that guides everything is that we will do no harm for the client. We want to make sure if we give a referral to another entity, commercial lender or, technology company or anyone else, that it's going to be something that will help them. A few years ago, I got a call from an online lender, and I knew very little about it. That online lender sounded pretty good. They were looking for referrals from us. They told me they were able to offer short-term money. It was quick and easy access. Stated rates, and they didn't say much else, was 10 to 20%, often available to be refinanced under similar terms. And superficially, it sounds like, hey, this is something we should let our clients know about. So I stayed on the line and started asking questions about what's the APR, what exactly are the terms, what is the fee structure, is there any closing requirements, that sort of thing. And they proceeded to basically give me unusual financial speak, if I can say that. I couldn't get a straight answer out of them, and I was a finance major. I hold my MBA. I've been doing this for a lot of years. And after speaking to the representative for about 30 minutes, I didn't know anything more after I spoke to them than before I did. I mean, it was the worst experience I have ever had in that arena. And I felt like an idiot, to tell you the truth, because they kept on repeating stuff. And the terms they were using didn't make any sense to me. And I think Pat was alluding to that recently when he was saying, the cost of the money as opposed to the interest rate to borrow the money. So the first thing I did was I sent out a blitz to all of our 24 centers that are seeing all these people. I said, be careful with this. You know, it doesn't sound like it's cricket. And we started an analysis, and what we found was that the clients that were gaining access to a lot of these lenders, they were talking about things like a 60-day term. And in that 60-day term, it was going to be a 10% cost. And a 10% cost in a 60-day term is equivalent to 60% interest, in my opinion. And that's an uninformed opinion, obviously, because I don't speak the same language that some of those lenders do. They also talked about a $500 application fee. They also talked about collecting fees in advance, which were reduced from the loan amount. And just in my quick analysis, I looked at a $20,000 loan for 60 days, and from my perspective, it was equivalent to gaining a $17,500 loan that would be paid back as $20,000 over 60 days automatically by giving this lender access to your bank account. So you didn't know when they were going to hit the account. You didn't know, what the exact amounts were. And if you're a small business person playing it close to the vest, you could be lining yourself up for a lot of bad fees, a lot of, bank charges that, shouldn't have taken place. And it ends up, if you work the numbers, it's over 80% APR on an equivalent basis. Now, that is not something that I would want any of my clients to ever get involved with. We put on a notification saying, look, we just want to make sure that the client knows what they're buying into if they take out one of these loans. It was a directive to all our staff. If we have marketing staff out there that didn't understand it, they were supposed to get one of our financial staff to meet with the client to make sure that the analysis was done so that they understood what they were getting involved with. And it was, it wasn't until last week that I actually ran the numbers for us in the past year. We've only had 4 clients get online lending from these, what I would consider usurious providers. Those 4 clients have all been refinanced through Pat's Excelsior Growth Fund. Mm-hmm. We were able to get them out of that one relationship, put them in something that gave them a longer term, gave them a real interest rate, and gave them viability. From my perspective, I think we have to be able to give the consumer, the small business person, the opportunity to understand what it is that they're getting. I mean, if I can sit there and talk to one of these representatives and not have a clue myself, and I do this a lot, I'm afraid what some of our businesses might be getting involved with. I mean, whenever we talk to them, we're able to help them understand it and get to the bottom line with it. But if we don't talk to them, there's a lot of them we don't talk to before they, as Pat indicated, sit at night on a Thursday night under a little bit of pressure, go online and say, I can get a response within 12 hours and I can take out this money and that fixes my problem. I don't have to worry about it until next week. And I think that's the situation a lot of folks are in. It needs to be addressed. There needs to be some consistency of language that we're talking here with small businesses and with other lenders. With that, I would just say that I really hope you do weigh in on this issue in a big way. If we have small businesses that are in financial trouble, they're going to be failing. And small businesses do a lot of business with other small businesses. So if you hear the cascading effect, if you have one solid business that goes under because of the financial risk involved, that business is probably doing business with 5 or 6 other small businesses, and those other small businesses will feel the effect directly. So it's going to cascade through our small business economy. With that, I'll obviously cut my comments a bit short and just say that I do applaud you holding this hearing and getting at the issue. And from the perspective of the University Higher Education Consortium that we have, I think that education is truly a key to this, problem. But in order to be educated, we need to understand the language. And right now, the language that these online lenders are speaking is a language no one understands.
Thank you. In terms of clarity, I'd like to understand the difference between the New York Business Development Corporation and the New York Small Business Development Center. How do you work together? How does that work for the public?
Yeah, we're strategic partners. We look at everything that NYBDC provides in terms of access to capital. We use them a lot, but we don't use them exclusively. Last year, we used 64 different providers of capital, ranging from small microloan operations to larger operations like, the major commercial lenders. They still make up our largest source of capital, but NYBDC is right there with it. They've been around since 85. We've only been on the scene since 55. We've only been on the scene since 84. So we're the young pups in comparison, I guess.
Thank you, Mr. Field.
Yeah, thank you, Jim, and appreciate your testimony. So far, I'm hearing two things, really. One is education. We should be educating and providing as much information and advice as possibly we can to educate small business people about the pluses and minuses of online lending. The second thing I'm hearing is disclosure, that right now there's no uniform system of disclosure, where you can look at things as apples to apples. I mean, things that people understand, like an APR, rate, things of that nature. So that one of the ways that the legislature could be involved with this is providing some sort of disclosure mechanism that is comprehensible to small business people. The third thing I just want to ask is okay, education, disclosure of what's going on out there. Are there things that we as legislators, practices that are so bad, so injurious to small business and competition, that we should just be outlawing particular practices, just saying, well, yeah, it's great to educate people, it's great to disclose what's going on out there and letting them make the decision, but are there some things that are so egregious that we should just be outlawing those particular practices?
I think a lot of it can be fixed through education and developing the common language. What our experience has been, if people understand it, they're not going to be abused by it. And if they're educated and, are regular consumers making a clear decision that they understand, they'll stay away from it. And there are alternatives. It's not a situation. I would think that rather than trying to say that any one component, you're always going to be able to find some individual small businesses that used an online lending platform correctly, and it worked out for them. You're doing a major state procurement. You need $100,000 quickly in order to perform on that procurement. The state pays you on time, okay? All those things given, they come off, and bam, you're able to pay that loan back. You built yourself a new, procurement level with the state. Everything is worked out. But if the procurement payment is slow by 90 days, all of a sudden you're taking out, as Pat indicated, that second or third loan from the online lender just to keep afloat. And you don't have the retained equity to support that for very long.
Okay. Thank you.
Thank you. Any questions from my colleagues? Ms. Fahey?
Thank you. Again, this is very helpful. You mentioned the cascading effect and some of the problems. Do we have numbers on the percentages of businesses that are failing through these online lenders, or any impact in terms of other businesses? Are there any hard numbers? I know this is somewhat of a recent phenomenon, but
I think they're just starting to get the failure rate analyzed at this point. Under normal circumstances, the USSBA always talks about 80% of small businesses are going to fail within 5 years of startup. And, I don't find that to be the case, so I don't, I look at some of those statistics and say maybe they're a little bit overstated, because sometimes when you have a statistic like that, they don't consider if you own the business and then sell it out, sell it as an ongoing venture, they consider your business having closed. And that, it translates into some bad numbers in those instances. But I can say that when businesses seek assistance, like the SBDC, they are almost able to turn those statistics upside down and say that 80% of them are going to be surviving and thriving after 5 years of operation, as opposed to in trouble. And when you see businesses oftentimes go under because of that cascading effect, I don't think there are any statistics yet.
Okay. Thank you. Very helpful.
Thank you. One question before you go. I was just thinking about the role that your agency plays, and people come to you with a business plan. Is that correct?
They come to us oftentimes seeking to develop a business plan.
Seeking to develop a business plan. And within the concept of that business plan, I know that I see businesses cropping up around the community, and sometimes I don't know if they've done any marketing analysis of that. How does your agency work with them to develop that marketing analysis so that they know exactly whether or not that's going to be a successful business or not?
Sure.
Because sometimes, people open up places and there's no walking traffic, there's no flying traffic, there's no bicycle traffic, that kind of thing.
No, we do perform the analysis with them. Okay, what we're trying to do is build their business acumen. So we're sitting down with them and we're saying, okay, you want to open up a restaurant, you have 10 seats here. Your overhead is going to consume all of your gross sales. You need to have a restaurant of 30 seats or you can't make a go of it. And just providing them with basic. I mean, in New York City, I dealt with an entrepreneur one day. She had a great idea. She was going to open up a nail salon in the back of a semi-truck. And she goes, I get rid of all the rent. I can do all this stuff. I'm going to invest it in my own, money I inherited from grandmother that, recently passed away, and developing this salon on wheels, I think she called it. And I said, have you run this by the New York City Office of Transportation? Because usually they don't like large semis sitting in the fashion district or somewhere like that for an extended period of time. And she said, gee, do I have to? And I said, yeah, you might want to. And she called me back about 2 days later. She goes, oh, thank you so much. I would have gone ahead and purchased this tractor trailer and had it renovated without knowing that I didn't have any way to conduct business. And that we provide some bad news, but what we find out is that when we give a committed entrepreneur bad news, they tend to come back. Because once you've been bitten by the entrepreneurial bug, you're not satisfied until you've got your business dream fulfilled. And that's really what happens.
Thank you so very much.
Sure.
Everyone's good? Okay, thank you so very much. Thank you, Mr. King. Jason Carballo, Chair, Government Relations Committee, Financial Service Centers of New York. Mr. Carballo.
Good morning.
How are you?
I'm going to some of the water here. Chairwoman Robinson, Assemblywoman Heineman and Fahey, Chairman Thiel, Pichardo and Santa Barbara.
Pull that mic closer to you, Mr. Carballo.
Sure.
Thank you.
My name is Jason Carballo, and I appear before you this morning on behalf of the Financial Service Centers of New York, the trade association that represents the New York licensed check cashing industry. I'm also the operations officer of Castle Financial Services, a licensed check cashing company that operates 7 check cashing locations in northern Manhattan and the Bronx. Castle was founded by my father and has been in business for more than 40 years. Now, the check cashing industry currently consists of 530 licensed locations throughout the state of New York. Our industry was created by the New York State Legislature in 1944 when it enacted Article 9A of the New York Banking Law. And since that time, we have been licensed and regulated by the New York State Department of Financial Services. Our check cashing fees are set by DFS and are currently 2.01% for every $100 of check value. Our rate is easily amongst the lowest in the country. The modern check cashing store is much different than the stores of yesterday. While once all we really did was cash checks, We now offer a wide array of necessary financial services. This includes cashing checks, the sale of money orders, money remittances with our partners, MoneyGram International and Western Union, electronic bill payments by which customers can get same-day credit, ATM and debit card cash-off access, and the sale of prepaid FDIC-insured saving accounts. We are also the largest vendor by volume of MTA-issued MetroCards. It is important to note that 7 out of 10 of our customers have bank accounts, but they make a conscious choice to use our stores because we offer them the best value. Our stores are located in low and moderate income neighborhoods. We maintain convenient hours and have friendly employees who speak customers' language. Given the often high cost of opening and maintaining bank accounts, which typically have minimum balance requirements and a variety of monthly service fees, millions of New Yorkers find using a check cashier preferable than using a bank. Our industry is composed largely of small businesses. However, collectively, the industry is big business and a major contributor to the economic well-being of the state. As an industry, we cash nearly 30 million checks per year, having an aggregate value of $11 to $12 billion. We process bill payment transactions for 10 million customers, amounting to $1 billion in payments. We sell more than 6 million money orders with a value of nearly $1 billion. And we also process 3 million money transfers per year, along with 750,000 New York City Housing Authority rent payments annually. And just as important, we employ 4,000 people, of which nearly 80% are minorities from the Black and Latino communities that we serve. Notwithstanding these numbers, I'm here today to do 3 things. 1, to explain the evolution of our industry. 2, to discuss the survival of our industry. And 3, to offer a solution to the problem. This hearing was convened to explore the lack of access to credit for small businesses in New York. First, our evolution. Not so long ago, our trade association was known as the Check Cashers Association of New York, and 90% of our industry's revenues were derived from check cashing. As our business model has evolved, we eventually changed our name to the Financial Service Centers of New York to reflect the fact that we do much more than just cash checks. Today in my company, only 50% or so of the revenues are derived from check cashing, and only 22% of my transactions are actual check cashing transactions. Our product mix reflects the fact that we have evolved. In fact, I submit to you that we are who we say we are, financial service centers. Our customers can conduct almost any type of financial transaction they need in our locations, and this includes saving money and, in some instances, conducting their credit union and banking transactions. We have evolved primarily to meet the needs of our customers. Now let me discuss our survival and the issue of the ability of the financial service centers to continue to serve the people of New York. As I mentioned before, there are currently approximately 530 licensed locations in New York, where a few short years ago the number was 660 licensed locations. As checks have declined and the payment of benefits, wages, and tax refunds have gravitated to electronic transactions, our check cashing volumes have decreased. At the same time, the cost of doing business, particularly in the 5 boroughs, has gone up. Our regulatory costs have increased as our regulator has seen a decline in New York banks, necessitating a larger share of DFS's budget to be borne by non-bank licensees. The cost of regulatory compliance has gone up as new federal, state, and local requirements have increased. Rents, wages, and operating costs have also increased substantially and will continue to rise. At the same time, Article 9A, the law under which we operate, has not been comprehensively reformed, preventing the addition of new products and services or the elimination of duplicative and outdated regulations. It is important to note that the loss of financial service centers impacts operators in the industry, but it also impacts our customers, your constituents, who have fewer locations at which to conduct their transactions. Fewer locations does not equate to fewer transactions. It means those transactions will be conducted at other locations, in many instances, unlicensed and unregulated locations. The result is less transparency and less consumer protection. Therefore, our industry needs the ability to offer new products, both on our own and as partners with other financial institutions in order to fully evolve and to survive. Now, our offer of a solution. One of the purposes of today's hearing is to explore ways to ensure that small businesses have sufficient access to safe, transparent credit products to help start and expand their enterprises. Another purpose is to examine the role of the online lending marketplace and to explore protections for small businesses. We in the New York Financial Service Center industry believe that we can be a part of the solution to the lack of available credit for small businesses, and that as a licensed industry in the state of New York, we should be. Inclusion of our industry as part of the solution is consistent with public policies of the state of New York to, 1, support the industry, 2, support small businesses such as ours, which provide thousands of jobs to minority New Yorkers, and 3, to ensure that other small businesses have access to capital in a regulated environment. Our solution comes in the form of legislation that is currently pending in this chamber and in New York State Senate. The bill is the Community Financial Services Access and Modernization Act of 2016, and it is designated as A9634. It is sponsored by Assemblyman Robert Rodriguez, and it is co-sponsored by Assembly members Arroyo, Benedetto, Pichardo, Perry, Crespo, and Linares. Multi-sponsors include Assembly members Abate and Cook. In the Senate, the bill was sponsored by the chairwoman of the Senate Banks Committee, Senator Diane Savino. A9634 is a comprehensive revision of Article 9A of the banking law, which has remained largely unchanged since its enactment during World War II. The changes proposed in the bill address a substantial evolution of the check cashing industry from its origins to the plethora of services currently being provided by our licensed financial service centers. It will modernize and streamline the licensure and oversight relationship between the Department of Financial Services and the industry. It will integrate technology into the licensure and oversight process and eliminate burdensome and redundant requirements of existing licensees seeking to expand or relocate a business location. The bill, in part, would address the contraction and closure of bank branches, especially in the poor communities, by permitting licensees under Article 9A to offer conduit services in partnership with licensed federal and state banks and credit unions. Through conduit services, our industry would be able to work with credit unions so that their members would be able to make deposits and withdrawals from their credit union and their bank accounts at local participating financial service centers. As a result, customers would have greater access to their accounts, or better yet, an opportunity for inclusion to mainstream financial services. Banks and credit unions should recognize the benefit from a wider footprint to potential customers without the cost associated with building branch brick and mortars. Most significantly, the bill would authorize financial service centers to obtain licenses under Article 9A of the banking law, provided they meet existing statutory conditions which would authorize us to offer small consumer and business loans. This new service would allow check cashers to provide businesses and consumers with a licensed and regulated credit product that would be an alternative to online loans, including loans currently being offered online. Financial service centers are already providing some services to small businesses, primarily in the form of cashing of commercial checks. In the process, we have developed business relationships with these businesses, particularly those that are located in the areas in and around our locations. This bill would not only assist our industry to survive, it would also squarely make us part of the solution to the problem this hearing is intended to address: the need of small businesses to access credit that is regulated, responsible, and transparent. I wish to express my gratitude to the committees for convening this important hearing and invite any questions you may have.
Thank you very much, Ms. Cabela. Mr. Thiel?
Not right now, thanks.
Not right now. Mr. Pichardo? Ms. Hyman? Thank you. Ms. Fahey?
Yes, please. Thank you. Appreciate your comments and your recommendations. If you would, because I'm not quite as familiar with the industry, I know of it obviously, but I haven't used it. Could you talk about, you've said that the solutions that you recommend, the conduit services and then the ability to make small consumer and business loans that would be regulated. We just heard this morning from others about the lack of regulation. Would you be limited in terms of the interest rates that you would be able to charge? In other words, the regulations that you work under right now, would that limit the interest charges that you could charge those if you were allowed to have this opportunity, or is that something that is in the bill that Mr. Rodriguez's bill that's pending?
Right. So currently today under Article 9A, there's a provision that forbids any lending on premises. So, for example, we have relationships today with various credit unions that allow us to accept member deposits and withdrawals. However, if that credit union were to ask us to distribute information with respect to below-rate loans that their members could take out, we are forbidden to doing that because there is a provision that restricts any type of lending on premises. If we were to strike that and allow for lending on premises, one of my examples that I give is that we would apply for, say, an Article 9 licensed lender. So today in New York State, you can be a licensed lender. You may remember the old household finance branches that existed in the past. We would be allowed to then apply for that license. However, yes, we would have to adhere to any and all laws that exist in New York State as it pertains to lending rate caps and so on.
And just so I understand, and forgive my lack of knowledge on the law, would you be at all, as a part of that requirement, does it at all limit the rates that you would charge, be able to charge?
Yes, it limits the rates to New York State's rate caps.
Okay.
There is no carve-out here. It is simply we want the ability to lend in New York State just like any other business does today, however regulated and licensed.
So you wouldn't, if you were to be authorized to do this, you wouldn't be able to charge some of the rates that we just heard about with the online banking?
Not at all.
The online lending?
Not at all.
Okay. Thank you. Very helpful. Thank you.
Mr. Santa Barbara? No? All right. Mr. Pichardo?
Again, thank you, Mr. Carvalho. Just a sort of a technical question. I believe that Assemblywoman Fahey was alluding to this issue. First and foremost, let me ask this. So the advantage to online lending is just simply the turnaround, right? So would your organization be able to compete with the online market space in a very similar timeline if you're going to create an alternative lending product, so to speak?
Yeah, I would say we would, and one of the main reasons that we would be is because, one, we have the data from a lot of our customers. We have their pay history. We have their bill payment history. We have their money transmittal history. We see their behaviors better than online lenders or possibly even banks do because we have these alternative types of transactions.
Sure.
So yes, we would. And in my opinion, be able to turn it around fast. But I'd also add that we'd do it responsibly. Very important. What we're looking to do here is to offer a loan product within the confines of New York State's rate caps where the margins are extremely thin. We want to make sure that these individuals can pay back these loans. Why? They're our customer. If they can't pay back a loan, then they're going to go the other 7 blocks to go to the next financial service center for their money transmittal, check cashing, or bill payment need. Second part is we're lending our money. That this isn't any money that we borrowed from the Fed at 0% interest rates or anything. This is the actual operator's cash.
Okay. And then just generally speaking, in terms of the volume of type of loans that you'll be lending out, you're a typical small business. I believe that the number was mentioned earlier was 300,000. Are you thinking to operate in that same space?
No, I want to fill the gap right below that. I'm looking for the several $1,000s to the 25,000. As a matter of fact, the Article 9 lenders, I believe the cap on the natural person, individual coming in is about 25,000, and to a small business is 50,000. We're not in a position, I don't believe, mind you, we don't lend, but in order to be into that space.
All right. Thank you.
Thank you.
Thank you. Ms. Hyman?
Mr. Carballo, thank you very much for this is very informative. So your business, you said that 50% of your revenues are derived from check cashing and only 22% volume. Where does the other 28% come from of revenue that check cashing businesses get their money from?
Yeah, the actual gross revenues come from money transmittal. For example, that's MoneyGram International.
Western Union,
right. Utility bill payment services, the sale of money orders, as I mentioned.
And
The sale,
and Metro cards, right?
correct, right, and the sale of prepaid FDIC-insured cards as well.
One of the things that you're saying here is using the credit unions in order to assist customers with getting loans to small businesses. Is there any other state that does anything like this now?
I don't know if any other state, I believe Maryland might have had a partnership with some of the credit union point of banking members, but I couldn't be sure. But as I said before, we have a relationship today with 7 credit unions that we act as a satellite branch for, where their members come into our branches.
Is MCU one of those?
MCU is not. We have not been able to meet with MCU.
What are some of those?
Actors Federal Credit Union, BethX Federal Credit Union in the South Bronx, LOMTO, which is Black Car Service Credit Union, and there's some other folks out on the island that we're members.
Do you know if Bethpage is one of those?
Bethpage is not.
Okay, thank you.
Thank you. Certainly, I want to thank you for your presentation today. Certainly, it has been enlightening for all of us. And also, I want to ask this question. Do you charge a fee for the purchase of Metro cards and for the rent payments that take place? How does that work?
Right. No, we're better than the automated machines at MTA. We are better than the MTA automated machines because we don't charge the dollar surcharge for the hard cards. Yeah, and our member agents, there is no charge to purchase or additional charge on top of whatever the face value of the Metro card is. To answer your question on New York City housing, rent payments, the charge is between $1.50 and $2.50
That's
per
what you
location.
charge for people to pay?
Yeah, that's basically the average.
Okay.
But now remember, most of that is same-day credit. So for someone living hand to mouth, it's important that their rent is paid on time.
And the utility bills as well?
Correct.
And there's a charge for those as well?
Yeah, it depends. You could have a relationship with Verizon or Con Edison where it is free, meaning it's paid for by the actual utility company to us, or on average, it's between $1 to $2 for a fee.
Okay, all right, thank you. Certainly, you have been tenacious in your efforts over these years that I've served as chair of the banking committee, and I see that it looks like we're beginning to turn things around a little bit.
Yeah, no, we listen.
Yes, you're beginning to turn things around a little bit. And so we will certainly evaluate what we've heard today and see how we might be able to perhaps come up with, there's legislation on the Senate side, and Mr. Rodriguez, Assemblymember Rodriguez, has legislation on the Assembly side with us, and so let's see how we can move forward to make something happen in our community to be able to assist people, and especially people that need a small business infusion. Because certainly that's the discussion I know in my community and my colleagues as well that have put their names on this legislation. That has been their experience as well, that many people come to them and say, I can't borrow any money. And whether it be for not only the business people, but also for community people who need access to some money as well. And so we'll be looking at this very carefully. And I certainly want to thank you, Financial Services Centers of New York, for your testimony this morning.
Very good. Thank you very much.
Thank you so very much. All right. Is there any person here that completes our list that we have before us this morning? Is there anyone here that did not sign in that desires to testify? Is there anyone here that desires to testify that did not sign in today? Is there anyone here that desires to testify that did not sign in today? Thank you so very much. This hearing is hereby closed. And Mr. Field, you have some remarks before we close out formally.
I just want to thank all of those who participated and testified today. It was informative and enlightening, and is greatly appreciated by the members of this panel. And it always helps if you turn the microphone on. I think that based on the information that we have received this morning, that there are certain avenues that both the Banks Committee and the Small Business Committee can collaborate on as far as looking at possible legislation, particularly with regard to disclosure and education, and hopefully we can focus our efforts in that regard and come up with some measures that are well suited to protect consumers and small businesses. So again, thank you everybody for your participation today.
Thank you very much, and to my colleagues that participated here today, and to the staff, thank you so very much.
Thank you. Thank you, Madam Chair.
You're welcome.